Hello and welcome to day number 102 of our Travel Trader series. And as I promised you yesterday, I want to dispel a little myth in the market that is around pretty much forever or for ages, and people still believe it, and that's the myth of gold being a safe harbor in times of crisis. And if you actually research it, you can read it over and over in all financial magazines and online in blog posts and whatsoever. You have people telling you to buy gold when the stock market is crashing because gold would go up, and so on and so on. And but if you really research it, and that's very easy to do, you just have to go somewhere and get the gold price. And you actually have to have a look at the crashes that we had, and then you will experience exactly the same thing that I experienced a long time ago, that gold is a safe harbor or safe haven in times of crisis is an absolute myth. So what we can see here is the gold price since January 2000, and as you can see, the slide is already a bit old. It goes to roughly March 2017, but it's plenty of crises in there that happened. And to show you something is basically that here we had the dot-com crash from here to here roughly, where the prices in the new economy went down and all the IT companies that were burning a lot of cash came down dramatically. And during that time, you can see, like in the initial reaction here, gold price goes down, then it goes kind of slightly down. It goes up a little bit, then goes slightly down, then it comes a little bit back up, and eventually, if you would have the exact look at the days, I think the gold price was actually $1 higher at the end of the crash than at the beginning of the crash. And if that myth would be true, you would expect, okay, because the stock market at the same time, some of them like dropped like 50%, and you would expect something similar happening here on the other, in the other direction, if they really would be correlated and going down as well. Here we have September 11th, if you can see this here. That's the day where it actually goes down. Like it went up a little bit later, like in the aftermath of 9/11. But on 9/11, gold dropped exactly as the stock markets and everything else. Now let's go back to the next crisis, the financial crisis, 2008, 2009. So if you put in here the times of the beginning of the crisis and the end of the crisis, you would see, okay, it's pretty much exactly the same point where we entered it. And here, a first reaction, unfortunately, the red bar is closing it, but we actually were higher here. Initial reaction is going down, then we are going up, coming down again, and then we drop down, going up a little bit, drop further down, then we are coming up again. So if you really thought that gold would have been the safe haven here, you were pretty much most of the time below the price and just a few times above the price. So the likelihood that you would have lost money in during that time, if you would have went into gold to sit out the financial crisis, that would have or could have been very, very costly. Then later on we had the downgrade of Greece, so we're now in the European financial crisis. And if the story behind the gold going up is basically that investors go from risk, which is supposed to be in stocks, and they shift to something, let's call it safe, and they are intended to go to gold. So if that would be true, that means the money that goes out of the stock markets, that's why the stock market is supposed to fall, and it would go into gold. This is why gold would go up. Now here we have the downtrade of Greece on the 16th of October, where the rating agency said, okay, we think that the debt burden of Greece is not bearable anymore, and therefore markets in Europe went down. And of course, it's like every time when something like that happens, you have, hey, buy gold, it's a safe harbor, and so on and so on. As you can see here, first reaction of gold was to go down. Then it kind of spiked up and it came down again. And if I remember correctly, like the price difference here from beginning to the end, that's the voting for the Greece rescue on March 25th, a year later. So that's when the crisis is over, and then you would expect, because now stocks and bonds, so government debt, is more secure now because Greece got finally rescued. So now all the money that went into gold should go back into stocks. So if you have stocks here and gold here, or let's say bonds, it doesn't really matter too much for the sake of the argument. So the money should go back from gold to stocks, so stocks could now go up again. And therefore, because people are selling on the gold side, the price should go down. But what it did in reality is the price went up. So after Greece got rescued, the price of gold soared up, which doesn't make any sense. So obviously the story is completely flawed. And if you think about other things, like if you continue to think a little bit further here in what is it, roughly middle of 2011, so May 2011, obviously gold spiked a lot. So I don't know if anyone remembers a huge crisis in the mid of 2011, but there wasn't pretty much anything. So obviously, gold is a commodity that has supply and demand, and supply and demand drives the price, and that doesn't necessarily have anything to do with risks. And we can see here in these examples that if we think about these crises that we had here, well, actually, we started here. So there's barely a difference in prices, and in many cases, you could lose a lot of money by simply following that advice. So it's an absolute myth. Now we can have a look, because recently it became more prominent with the stock market going down, and that's when you could read all these headlines of buy gold again. So let's have a look what happened here. This is the chart of the S&P 500. So the 500 biggest stocks in the United States, S&P 500. And if you have a look at that, you can see, okay, here from the 21st of February, we started to go down. Now look at that pattern. We went down roughly until the beginning of March. When we went up, we dropped down again. And here from roughly the mid of March, we started to go up again. Now remember that pattern, going down, going up, going down, and then going up again. It looks a little bit different, but if you have a look at the gold price, so here we are in gold. You can see here it's a little bit moved to the side, but basically if you would move that picture here, we could see something very similar. So here's March. And when we go back here, we see, okay, the 21st, so end of February. So here, that's roughly end of February 21st. We go down, we come up again, roughly until the 10th of March. And then we drop down again at the end of March. When the stock market goes up, we're going up again. So it's exactly the same. Mid of March, we're going up. Here around 10th of March, we're going down, and here we went down before. So down, up, and it's a little bit different, but here when the crisis started, we went down in gold as well. We came up again, but then we dropped down again dramatically, and now we are recovering together with the stock market. So actually that looks very, very correlated to me, but people keep telling you that you should buy gold when the stock market goes down, but actually when the stock market goes down, gold price came down dramatically as well. So in the height of it, you could lose like 25% in the gold price. And for me, it's important to tell people about it because that myth is around for so long and people believe it because you hear it over and over and over again. And I keep telling my students the same thing for years because when you think about risk management, which is something that we love to do, so we want to be safe, but we cannot be safe by switching from stocks into gold because obviously that doesn't work. So part of my risk management is to tell people about, okay, look, what many people think or believe works actually doesn't. And it's very easy to demyth because all you have to do is have a look at reality. So don't trust everything you read in whatever Financial Times, Wall Street Journal, or Money Magazine, or whatsoever you find, or what all these gurus are telling you. You can always listen to these things, but make sure you do your own research. And if you do, you realize that in the case of gold, it's simply just a myth, it's not true, so we shouldn't follow that. And yeah, that's what I wanted to share with you today. Tomorrow we are going to look again a little bit deeper into some indicator. And I thank you very much for your attention, wish you a great evening, and hope to see you again tomorrow. Thank you very much and goodbye.